Welcome to another video from Creativo Solutions. You're actually watching the podcast series. The audio comes from live content recorded from live classes. I hope this content will help you learn something that will add value. Please consider subscribing to this channel and visit our website for more information. You will hear audio covering the bank reconciliation.
Why is bank so important for a business?
For profit, losses, cash flow.
Yes, cash flow is key. So bank is a very important account purely because businesses rely on cash flow. So a business will have internal records, and the internal records will either have an asset or a liability for bank. Bank, we know, can either be an asset. If it's an asset, it will have a debit balance, and a debit balance will be favorable. Favorable means good. Businesses want a favorable bank balance because a business needs to have cash within the business in order to operate. Do you guys agree? When a business is obviously operating, they need to identify what the balance is. Is it favorable or unfavorable? In our internal records, this will be recorded in the general ledger accounts. So you'll have one account for bank, and you'll have debits and credits. In the actual account, you're going to have a balance that will be brought down or carried down, and you'll then identify what the actual account has in terms of opening and closing balances. Businesses want more cash. So ideally, you'd want your cash to increase rather than decrease. That will be a good sign that the business is doing well in terms of inflow and outflow. Can we have a liability? Yes, we can. If bank is a liability, remember this is our books. So in our books, we're going to have a credit balance. That's unfavorable, and that'll come from the general ledger. So that's what you've got when looking at this. Internal records. Who's the external party in this relationship? So there's always two parties in every relationship, right? Okay, so the business is the focus. We know that. We've looked at the business's perspective. The business is going to have a debit for a favorable bank balance and a credit for an unfavorable bank balance. What other party is in this relationship? Well, customers if we were buying or selling, and creditors if we were buying or suppliers. We're not looking at that. We're looking at bank.
The actual bank?
Yes, the institution. Do you agree? The financial services provider.
Yeah.
That's the other party that's part of this relationship. Do you guys agree? Yeah? So when focusing on bank, there are going to be two sides to every section. Okay, so let's copy that. And let's highlight the external records. Okay, so obviously, you guys all have bank accounts and you get bank statements. Do you agree? And those bank statements show you what's actually in your bank account. So if I'm focusing on the external records, how do you know what's in your bank account? Is there a general ledger? No. What does the bank give you? A statement. So the bank, in terms of the financial service provider, the actual bank's records, the provider, FSP, I'm just going to use that, financial service provider, is going to give you a bank statement. Right, so you are probably going to get emailed the bank statement, okay, or you can log on and check your bank statement, or you might even get posted a bank statement depending on what form of communication you have with your bank. Right, but a bank is going to give you a statement. Why do they give you a statement?
To see your transactions.
Confirmation, correct. To see transactions, do you agree with the transactions that have taken place during the month? How often do we get a bank statement? Once a month. Every month you should get a bank statement. You can ask for bank statements that cover a longer period. That's possible. But generally, you'd get a month-to-month bank statement. Businesses would want a month-to-month bank statement because for the month, the business needs to check what were inflows, what were outflows, what are all the transactions that relate to the bank account. So if I'm focusing on external records, you guys have bank statements. What bank statement balance do you want to see on your account? A debit or a credit? A debit. So do you guys all want to see debit balances on your account? Really? I think Mika, so would I. Why? Why, Mika?
Because the debit, isn't it the money that they debited from the account?
Okay, so do you agree there's two parties to every side of the transaction? Okay, so if I'm looking at my records in my general ledger account, do I want to see a credit? No. In my records, in my general ledger account, I want to see this. A credit, debit, because that's the favorable bank balance. In the bank statement, do I want to see a debit or a credit? Yes. Okay, it's the opposite. So when looking at a favorable bank balance, you want to see a credit balance because the bank has a liability. So there's always the opposite to everything. It's like creditors and debtors. If you buy from a business, the business is your creditor. Do you agree? You are the business's debtor. Does that make sense? Right, so you've obviously got debtors and creditors in the same situation. The same thing applies here. You've got an asset and a liability in the same situation because your bank balance is an asset, so the bank will view your asset as their liability. Right, because what is the bank's function? It's to provide you with a service, okay, or a product, depending on what you're buying, okay, or what you're taking out. So when focusing on bank, do you agree cash flow is important to manage? So the bank is going to help us manage cash. Let's think about a big retailer. Okay, maybe you went past the shops before coming in, and let's think about how much cash did that retailer collect during the day. Okay, like a big retailer. So your Woolies, your P&P, your Checkers. How much do you think they would collect a day? Okay, think about how many customers go in and out that store every minute, every second, every hour. Okay, so they're probably collecting a few 100,000 rand cash every day. Good or bad? Good, but bad because now we need to manage all of that cash. Right, it's great having 100,000 rand sitting around in the business's office, but it's a very, very high risk. Okay, because can you track cash? No, you can't. Okay, cash doesn't have any like ownership, okay, because it's easily transferable between people. Right, so if you give someone money, that cash is no longer yours, and you can't identify it as being yours. Do you agree? This is a form of exchange. No one writes their name on all those notes and coins, okay, to identify it as being belonging to a specific person or business. Do you agree? Okay, because then you're defacing that currency, that money, okay? We shouldn't be writing on notes. Right, so when focusing on internal and external records, a business needs to keep all of that cash within the business and they need to manage it. So why do we consider using a bank? What's the benefit? Okay, that's one. So I could possibly earn interest on all of that cash. Right, so if we're looking at the big retailer, a few 100,000 rand cash, earning interest in the bank, good or bad idea? Good idea. Okay, even if you earn very small amounts of interest on a very big amount of cash, that makes sense, right, to keep the cash with them rather than at the office, okay, or in the safe. Right, what else? What other reasons would you come up with for motives for using the bank?
To manage.
Correct. Security is another one. Okay, so you don't want the liability or the risk of having to keep track of all the cash that you have in the business. Right, so the tools that we have in the business, is that a risk? Yes. Okay, now where does all that cash go eventually?
In the safe box.
Probably in a safe, okay, or yes, or collected by one of those cash collection services. Okay, those big armored trucks, right? Easy to provide that service or difficult? It's difficult. Okay, you need an armored vehicle. You can't just have any vehicle. You need security guards that are trained. Okay, so expensive for cheap service to make use of. It's expensive. Right, but that's the risk that you take for not using those services. Right, do you want lots of cash sitting in the business? Not a good idea. Right, so large businesses require good cash management, and having bank accounts help with that. Another way of viewing this is it important to keep track of these accounts? Why? Say that again? Okay, good. So do you agree the business is going to enter into transactions and the business is going to buy and sell? And this bank account, lots and lots of transactions are going to be going through the records. Okay, do we need to confirm that what we have in the bank account is correct? Do you always agree with the transactions that are on your bank statement?
No.
Not always. What can happen?
Fraud.
Fraud, perhaps. So maybe someone got access to your account and taking out cash incorrectly or fraudulently.
Orders that are not authorized by you.
Debit orders that aren't authorized. What else?
Double debited.
Maybe double payments. Okay, duplicate payments. Good. What about bank charges? Also something to consider. Where will you see your bank charges?
Bank statement.
On the bank statement. So that's the source document. Okay, so when looking at the bank, you've got two parties, internal and external. Do you want to see a favorable bank balance on your bank account? Yes, and that would be representative of a credit balance. Because if it's a credit on your bank statement, that means you've deposited money with them because it's safekeeping. Right, so the bank is going to keep that cash safe for you as the customer. Right, and it's also convenient. Do you want to carry cash around with you? It's also not a good idea. Okay, maybe a small amount of cash in case, but carrying too much cash can also be risky. And it's easier to also use card payments. Okay, swiping and paying electronically is a lot easier than having to take out cash and to provide the cashier with it. Okay, it's quicker as well. There's no change that needs to be given. Right, so it can be quicker in some instances. Right, so if I have an unfavorable bank balance, will that be debited or credited? Debited. So unfavorable bank balance is a debit balance. Why? Because the bank has an asset. Okay, so there's always two perspectives, yours and theirs. Your perspective, I've got a liability. If you've got a liability, then they'll have the assets. It always goes hand in hand. It's like your debtors and creditors. Let's change this color. Okay. Right, so those two are important to note because you're looking at your books and you're looking at their books. Let's just make a note. Your books or your records and their records. their records. Okay, that's important to note, or their books. All right, something else to consider is, can you change what's in your books? Yes or no? Yes, you can. Why can you change things in your books? Correct. You have control over your accounting records. Right, can you go to the bank and change their records? Yeah, all right, perhaps, okay, but not something that you can do. Okay, why? Separate legal entity. The bank is operating as a separate institution. Right, you're running a business, they're running a business. They're two separate entities. Okay, so you can't interfere with their operations, and they can't interfere with your operations. But do you guys need to check that both are correct? Yes. So we need to make sure that we're all on the same page. What's in our records and what's in their records are matching. That's the key. And that's what a bank reconciliation is. So just to highlight this, bank reconciliation. Right, a bank reconciliation is looking at that. It's a asterisk. It's a checking or matching or confirmation process. That's what we're looking at. Okay, so I want to know if I'm doing things correctly, and I want to check if the bank is doing things correctly. The only way we're going to know if the records are corresponding is by looking at the bank statement. Okay. Something else to consider is the adjustments. Okay, so asterisks. What can I do in my records? Well, I can process journal entries which affect the general ledger account. Right, so that's what we mentioned earlier. Can I adjust our internal records? Yes, you can. Okay, so adjust here. You have power, you have authority, you can do whatever you like as long as it's in line with the rules, okay, the international financial accounting rules, okay, the standards. If you want to process transactions, you can. So that's the adjustment. I can adjust things in our records. Can you adjust things in the bank's records? No. So if those are your books, you can do a certain amount of adjusting. In the bank's records, I can't. So what happens if you find mistakes? You go to the bank, you go to the branch. Yes, you speak to a consultant. Okay, they process your query, and if they agree with what you've identified, then they make the correction. Okay, so are we going to be able to adjust here? No adjustment. And that's why we use a reconcile or reconciliation statement. Okay, so reconcile with the bank. Okay, no adjustment. No adjustment. Let's highlight that. Okay, so two things. Number one, adjust if your books need fixing, okay, changing. Number two, reconcile if you're going to have to confirm that the bank has done the correction. Okay, because remember, you raised the point. So you go into the branch and you say, well, here's a problem with my bank charges. Okay, or there's a problem with the debit orders, or whatever the case might be. And then you're going to have to check a bit later, okay, maybe next month, you'd have to check, did they correct what were the mistakes in the previous month? Right, because remember we said the bank statement only comes once a month. So that's when you're going to be checking it. Right, so that's our focus for this week. We're looking at the bank recon. We're going to be processing a business's records. Okay, we're going to confirm that what's in their records and what's in our records are correct. All right, something else to consider now is the process. So bank reconciliation process. step number 1, let's discuss it. Okay, whose books can't change?
Yes.
The banks. Well, they can as long as you've reported something. Okay, but they're not going to change things automatically or make corrections unnecessarily. Right, so can I change the bank statement? Okay, so you start with the bank statement. Right, and that's the first thing that you're going to check because it's external, so it's someone else's view. Right, so let's look at their view and let's see what has happened in this account, okay, over the last few days, okay, of the month. Step number 2. Compare the bank statement to your records, internal records. That's step number 2. Right, so now you're looking at the bank statement and you're checking what's there to what's in your records, okay, because that's the confirmation. Right, so I know that the bank has accounted for certain transactions. I know that we've accounted for certain transactions. So then after we've received the bank statement, we're then going to check what's on the bank statement and we're going to compare it to what's in our books. Okay, because remember, the bigger the business, the more cash they're going to be dealing with. Right, and this is a very important bank account or just account in general that we need to monitor. Okay, there's no other account that's more important for a business than the bank account. Right, because cash flow is what bankrupts a business, not profit or loss. Okay. Right, step 3 is to consider who is correct. And you'll see what I mean by this later when we look at an example. Right, there's 2 questions that you need to ask. The first is who's correct, okay? And then you need to consider, well, step number 4 would be, okay, when I say who's correct, then you're going to look at this, adjust or reconcile, question mark. Right, so we need to discuss what that means. Let's highlight the word adjust. Okay, and reconcile. Can you do both?
You adjust your records and then you reconcile.
Okay, you only do one. All right, so every transaction will either have to be adjusted or reconciled. Okay, you'll never do both for one transaction. You could have different transactions and then those transactions would have to be adjusted and reconciled. All right, so if I'm looking at an adjustment, what is an adjustment? It's a change to your internal records. Okay, so CRJ, CPJ is going to affect the bank. If I look at who's correct, I'm looking at are we correct? So business or bank? That's what we're asking. Right, so if we're correct, are we going to adjust?
No.
Of course not. There's nothing to adjust. If we're incorrect, then we are going to adjust. If the bank's correct, are we going to adjust or reconcile? If the bank's correct, that means we need to fix. Does that make sense? Okay, if the bank is incorrect, do we adjust? No, we'll have to reconcile. Right, so asterisk, adjust when the business's records need to be updated or changed. Okay, let's just use the word changed. Right, so that's when you adjust. You only adjust if the business's records need to be fixed, changed, whatever. Okay? Then we reconcile when the bank's records need to be, I'm going to use the word updated, bracket, the bank does the change. Okay, so no one can change the bank's records other than the bank. You can report errors and mistakes, and you can ask the bank to change your account, okay, your bank balance or the transactions, depending. Okay, that's what you're looking at. So 4-step process. That's all. It's simple, it's easy, it's straightforward. It takes practice, though. Okay, so in this particular section, there are certain types of transactions that come up more often than others. Okay, we'll make a list of those later on. Okay, right now, if we discuss them, they're not really going to make much sense. Okay, so if I talk about outstanding deposits, okay, it might make sense, but I want you to see what it looks like first, and then we can discuss it, and then it'll make more sense. Okay, so we'll make a list later of the different possibilities, okay, that can come up in a bank recon. You guys have seen one already. Yeah? When we spoke about debtors, we spoke about a dishonored check.
Yeah.
Do you agree?
Yes.
How do you know if a check has been dishonored?
It bounced back.
The bank is going to inform you that the check hasn't gone through, and you're going to see it on your bank statement, because who would have deposited the check? The business owner. Right, so if Jafta, as a business owner, receives a check from Linda, he's going to deposit the check, right? And that takes a few days to clear. Whether you have money or not in the account when giving him the check will determine if the check goes through or not. Right, so the check doesn't go through. A few days later, Jafta sees a dishonored check on his account. Does it make sense? Right, you're not going to see anything in your account if you're the one writing out the checks. Does that make sense? Okay. Question.
And that concludes this audio session. Thank you for listening. Consider subscribing to the channel, and if you like the video, please hit the thumbs up button, and we'll keep creating more content to help you.